Doing the microphone adjustment, the screen adjustment. Not that it's going to help much because yeah, light sucks. The microphone and the webcam, everything sucks. It is 2:57 Turkish time. I shall start in 3 minutes, and I shall be talking about the latest measures taken by the Central Bank of Turkey, why money printing, as we colloquially call it, has become a necessity, and whether there was a better option, because clearly printing money for countries like Turkey has side effects. And these side effects are manifesting not only in the foreign exchange market, but also in our CDS and Eurobond markets as well. So this is nope, this is not. I am just adjusting a few things if I can, but not very successful in doing so. Already I see several fans joining, and I shall be addressing them ASAP as soon as I I can adjust my settings. Okay, well, I clearly failed to do so. And 2 more minutes, then I shall start our official Real Turkey channel live broadcast. Soon we're going to add singing and dancing girls in the background, as well as an orchestra to make these more exciting. But in the meantime, you're stuck with my face. I'm thinking of getting a facelift, which should improve our membership and audience. Once again, I'm doing my best to get decent audio and video quality to you, but everywhere internet lines are overloaded because people have nothing to do but to stay home and watch videos or chat with their friends or find girlfriends, boyfriends, whatever their sexual inclination is. Okay, we can start because I'm aghast with anticipation and excitement to reach you. Dear YouTubers, welcome to Real Turkey channel. My name is Atilla Yeşilada. I'm your loving, caring, kind, and gentle host. And I shall be talking about Turkish monetary policy today. 2 days ago, the Central Bank of Turkey announced that it's starting asset purchases, which, even though it's not exactly identical, would mean in colloquial terms that it's going to print money. I'm going to address several questions in this brief broadcast, which would probably last about 5 hours or so. First, how is the central bank conducting these operations? What kind of assets will be purchased? What could be the potential magnitude of this asset purchase program? What will happen to the money thus injected to banks and the Treasury? Why was this necessary? And finally, was there a better option? Simply because if you follow Turkish financial markets, you would see that Turkish lira is under severe pressure. Not only that, Turkey's CDS premiums, which measure the possibility of default on sovereign debt, are increasing about 600 basis points, and Turkish Eurobonds are coming under selling pressure. Okay, the central bank is going to pursue 3 avenues in terms of asset purchases. First, it already holds a portfolio of government bonds to regulate its open market operations. it is buying bonds throughout the year. Now it said it's going to front load these purchases. So its annual purchase program will be brought forward, probably the entire purchases to be made within a month. Even though the exact amount is not known because central bank said that it could raise the ratio of these government bonds in its entire balance sheet, reliable economists forecast that up to 20 billion liras of new bonds may be purchased by the central bank. For your information, the dollar TL exchange rate before I began this forecast was something like 6.67. I am sorry, I should turn this down. I don't know why people call at this time. Okay, I continue. Secondly, Turkey has an unemployment insurance fund, like your Social Security fund, I suppose, which is part of the general budget. So we make our contributions, but these are not kept under a separate fund. It simply goes to the Treasury, and Treasury says, I'm obligated to pay you off when you're unemployed. Now, of course, unemployment claims are increasing, and the fund needs liquid assets. So the fund is going to issue bonds, which will be given or sold to banks, and these will be used as collateral to borrow money from the central bank. The fund has roughly 150 billion liras of net assets. Last time I checked, how much of it it will have to liquidate depends on how many claims it's facing. But I presume that within 3 to 6 months, the entire net worth of the fund may have to be exhausted, because I read reliable economists who did some empirical or simulation research. By the end of the second quarter, Turkey may have another million people join the unemployment rolls. Assuming tourism season is lost, the number of unemployed could increase by up to 2 million, as well as, of course, conditions to qualify for unemployment insurance will be relaxed over time, as our Finance and Treasury Minister, Mr. Berat Albayrak, has promised yesterday, or was it the day before? I don't know. When you stay home all the time and don't turn on the lights, day and night are meaningless concepts. And three, it said it's going to purchase asset-backed securities and mortgage-backed securities, which is kind of questionable practice because we don't have those. So first, these securities will have to be created by banks, packaged, securitized, and then they will be sold, presented to central bank as collateral, and central bank will inject liquidity to the banks so they can make further loans. All of these practices are widespread in developed markets. Fed does everything. In fact, it even has a facility to buy corporate paper, very short-term debt obligations. European Central Bank buys everything in sight. The Bank of Japan even buys equities, I think index funds. So Turkey is playing by the international playbook, but unfortunately, Turkey is not Japan or the United States. Why was central bank forced to print money in a country where inflation is running at 12%, but the TL deposit rates are about 9%, so there's massive dollarization? Very simple. The Treasury needs money to feed the unemployed people and people in poverty, but its coffers are empty. The Treasury used all of its ammunition to prevent a recession in 2019, and now it doesn't have too much cash reserves, maybe 100 billion liras, which is one and a half month of spending. As part of Stability Shield, Turkey's economic measures to combat the economic impact of the COVID-19 outbreak, taxes have been deferred on many sectors. And of course, the entire services sector has been shut down, either by government mandate or voluntarily to preserve social distancing measures. Services are roughly 60% of the Turkish economy, and obviously they are extremely labor intensive. So these people are not going to pay any taxes. I'm sorry. Excuse me. So the government's tax revenues are going to go down substantially, whereas its expenditures by necessity are going to increase. As I've said, it will have to pay unemployment insurance, and it may even have to resort to direct cash injection, that is, writing checks to people who become unemployed. Currently, the magnitude of the economic relief package is 100 billion liras, or roughly 2% of GDP, which is seen as grossly inadequate for a country. Experts suggest such packages ought to be at least 5% of GDP. And of course, the Treasury doesn't have the money for that kind of thing. Also, it can't borrow from abroad because, for those of you who follow financial markets, there is a huge panic attack in emerging markets. In fact, Financial Times today published an article which said investors are concerned about a credit crisis in emerging markets. Last time I checked, Turkey's benchmark Eurobond was trading at a yield of 8.7 or so, which is an excruciating interest rate if the Treasury were to borrow from abroad. Of course, the Treasury will borrow domestically to cover part of its expenditures, and it has already announced so. In April, May, and June, its net domestic borrowing will be 30 billion liras. But there's a limit to that as well, because in Turkey, we don't have a fund management industry or life insurance industry large enough to absorb the paper coming from the government. It is commercial banks that are essentially the only bidders for these bonds, and they're already squeezed for liquidity because they are making loans to small and medium businesses, to people in distress, to make sure the economy churns and it doesn't come to a standstill. So there was really, as it appeared, there was really one option, which is for central bank to print money, which would be taken up by banks through open market operations, and then it will be lent to the Treasury. Unfortunately, money printing has side effects. For one thing, we live in a country where trust in government is very low. In that sense, we're very similar to the United States. We don't trust those bastards. And now, over the last 3 data weeks, we have seen Turkish retail investors starting to withdraw their hard currency deposits from commercial banks. It's not a run on banks. The sums are small, a couple of $1 billion a week. But it's clear that there are significant concerns that the step after money printing is capital controls or somehow conversion of FX deposits into TL or whatever. I don't agree with that viewpoint, but I can't change the people's perception. So money printing has led to further dollarization. And of course, we know from the experience of Fed, which started QE, quantitative easing, in 2008, that the money doesn't necessarily go to purchases of real assets or to production and capital investment, but to financial markets. If you look at the performance of Standard & Poor 500 index since then, it is largely due to cheap money rather than the performance of the companies per se. In essence, many constituents of S&P 500 borrowed on the cheap and bought back their stocks, which reduced the quantity of equities shares in the market and bolstered the prices. In Turkey, this excess liquidity will seep into the equity market. This is why the equity market is at this time outperforming the overall MSCI emerging markets equity index. But it will also go to the foreign exchange market, and that's a problem. As I've said before I started this live broadcast, dollar TL was at 667, and I believe, though I can't prove, that it should have been much higher, probably about 675 to the dollar, if state banks, on behalf of central bank, weren't selling hard currency. More importantly, an honest market where there is no Turkish intervention, the CDSs are above 600 basis points last time I checked. These things change, the price changes every minute, and I don't have a Bloomberg screen in front of me. So these are, tentative prices. They're not accurate to the hour. And this simply means that borrowing for Turkish banks and corporates would become much more expensive. And finally, we have seen the true benchmark domestic TL denominated government bond, the 10-year bond, the yield rose to 13.75%. To give some perspective, it was as low as 10% by the beginning of the year. And the euro bonds are under massive selling pressure. I'm not saying all of this pressure is because of the central bank decision. As I've said, the dollar index is strengthening, and emerging markets are in the midst of a capital flight of biblical proportions. According to International Institute of Finance, only in March, $83 billion of financial capital has left emerging markets. But Turkey's situation is compounded because of this decision. So money printing comes with a lot of side effects. And therefore, I, as an economist, ask myself, I think the entire economist community is asking, whether there were other options before resorting to money printing. And in my view, there were, yes. One would be a wealth tax, a one-time tax for the wealthy, for the very high income earners, or for those who have declared very high levels of wealth, say in terms of $1 million, to the tune of 1%, 2%, and a measure that was tried in 1994 crises, which would have filled the coffers of the Treasury. Two, of course, belt tightening. Turkey spends a huge amount of money on, in my view, frivolous infrastructure projects and other current expenditures. This could have been cut. And in my view, these discretionary expenditures are roughly 20% of the entire budgetary outlays. A good 5 to 10% of the annual budget could have been saved that way. Another way of generating savings is to use force majeure on the operating consortia of the toll roads and tunnels and the Istanbul airport, which receive periodic payments for the government if they don't have enough traffic. They too should put their hand under the stone, as the Turkish saying goes, that is, to make a sacrifice. And of course, another measure is to issue dollar-denominated bonds by the government to suck up the excess dollar deposits and to give retail investors a decent income-earning asset in hard currency terms. Turkey can't borrow at less than 6-7% in short maturities abroad, but Turkish banks offer at most 2% for dollar deposits. So a one-year bond offering, say, 4%, 4.5%, and guaranteed by the Treasury, should sell like hotcakes. And of course, the simplest measure would have been to apply to IMF to tap their coronavirus aid uh, package. IMF says it has set aside a facility worth $1 trillion. Already 82 nations, even Iran, has applied to get some of that money. The conditions are not as stringent as a standby. The money ought to be spent on healthcare expenditures and on, helping the unemployed, I believe. But Turkey refuses to take that venue because, for some reason, in the mind of our president, Mr. Erdogan, IMF is a dirty word. He somehow thinks getting money from IMF under any condition is sacrificing our national sovereignty. In the meantime, we don't mind getting money from the World Bank or from the institutions like JP Morgan or Goldman Sachs or the Chinese through our wealth fund, which apparently is not sacrificing our national sovereignty, but IMF it is. I think at the end, Turkey will have to apply to IMF because all of these measures will not be sufficient to cover the welfare needs of a population that is going to lose jobs steadily over summer months. I think I have broadcasted before that I am extremely pessimistic about the course of this pandemic. As it peaks in one continent, it pops up in another one. Right now, I'm focused on India, Russia, and in Latin America and certain spots in Africa. And if the virus is present in some country, it just spreads to the neighbors and then comes back to those countries which have already sorted it out. Read a New York Times article which says this recession is going to last longer. I believe that. I think throughout the year, more or less, we're going to spend our lives in our homes, won't be able to get jobs or won't be able to make enough money. And countries like Turkey ought to prepare for this eventuality. And if Turkey doesn't, apply to IMF, the currency would lose value massively, which would eventually impact inflation and destroy corporate balance sheets. To me, two things need to be done for me to be optimistic about the Turkish economy and Turkish financial markets. A, President Erdogan declaring a nationwide curfew, because this appears to be the only effective way to stem the tide of this nasty virus. Two, as I've said, an application to IMF to get the funds that we need, which is not the most desirable way, but probably the one with the least side effects. Thank you very much. This has been a broadcast of Real Turkey Channel. I shall be broadcasting more frequently, not because the audience demands it, because I have nothing else to do. And I would appreciate if you subscribe and, more importantly, share this video with your loved ones if you want to punish them, or with those people who do business with Turkey or who follow Turkey for academic reasons. Until next time, stay home, stay safe, and shoot people who want to shake your hands. Atilla Yeşilada out. Peace be with you.